Ladies and gentlemen, good day and welcome to the Ramco Systems Q1FY2023-24 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vivek Doshi from DAM Capital Advisors Limited. Thank you and over to you, sir.
Thank you. On behalf of DAM Capital, we welcome you all to Q1FY24 conference call of Ramco Systems. We have with us Mr. P.R. Venkatramana Raja, Chairman of the company, Mr. Subramaniam Sundaresan, CEO of the company, Mr. Sandesh Bilagi, COO, Mr. R. Chandran, CFO, Ms. Gayatri, VP Finance, and Mr. Vijay Raghavan, Company Secretary of the company. I will now hand over the call to Mr. Venkatramana Raja for his opening remarks. Thank you and over to you, sir.
Good evening and thank you all for joining the Q1 earnings call of Ramco Systems. I'm pleased to introduce our new CEO, Mr. Sundar Subramaniam, as we call him, as our Chief Executive Officer and as an accomplished global technology leader with over 30 years of experience. Sundar in his new role will lead the organization and further build upon Ramco's portfolio of enterprise offerings with a renewed focus on execution and growth. I'm confident that the appointment of Sundar as a CEO will strengthen our focus on operational excellence, strategic expansion and capitalize on new opportunities to achieve sustainable growth. On the business front, we witnessed steady momentum across our order booking in our order booking and in our revenue also. All business units have witnessed growth in Q1 compared to the previous quarter. With this background, I will now turn over the call to Sundar and Sandesh to walk through the further details for this quarter. Thank you.
Thank you, PRV. Good evening, everyone, and thank you for again joining us for the Q1 earnings call. It's really a privilege and an honor for me to lead Ramco System and to be on this call. I'm pleased to share with you that we reported a strong quarter. Our revenue went up by 11% QOQ, and the quarterly order booking stood at $23.14 million. This is the fourth consecutive quarter where we booked order over $20 million. So that's been a steady performance over the last 4 quarters. With this order bookings, our unexecuted order book is at a very healthy $196 million, which is highest in our history so far. Our cloud orders that are primarily subscription-based SaaS solutions continue to show accelerated growth, and that is reflecting well in our numbers as well. As of last quarter, 60% of our revenue came from our cloud and SaaS customers. Our key strength lies in our IP-rich platforms with product trailers to different industries. We continue to invest and leverage next-generation technology as we enhance our design and delivery capabilities to deliver exceptional value to our customers. Now I request Sandesh to share further details on Q1 performance.
Thanks, Sundar and PRV. Good evening. The momentum of consistent order booking over 20 million per quarter has come on back of 4 million plus orders we have signed in the Q1. Let me give some color on the quality of deals we have closed in the Q1. We have secured largest ever order for our HRP business unit from global insurance company to streamline their multi-country payroll operations across 24 countries. One of the largest global aircraft manufacturers awarded contract to modernize their maintenance and engineering operations. We have secured additional business from one of the top global banks in APAC in the program to consolidate payroll across 27 countries for 7,000 in-scope employees. All our HRP deals closed in this quarter have deep influence from our partnership signed with Oracle and Workday. Also, recurring revenue stream has improved with every passing quarter. We have added $1.2 million of top line in recurring revenue per quarter compared to same quarter last year, effectively year-on-year growth of 15%. We have witnessed 11% uptick in quarter-on-quarter revenue and are optimistic that this positive momentum will further build on in the next few quarters. Growth during the quarter is fully aligned to our strategic focus on defined business segments and geographies. New customer acquisition has been across industries in AAD, global payroll, global payroll, and ERP. Europe, which is a relatively new market for us, has shown a good promise and good growth during this quarter. While our booking is growing and the pipeline of deals are getting converted at healthy pace, we are being watchful of the macroeconomic environment. In closing, I want to mention that our investment in technology and innovation continue to yield results. The quarter witnessed improved operational efficiencies and finer client engagements. At Ramco, I am confident that with strong order bookings and increased revenue visibility, we are at the start of another interesting quarter. Now we would like to open the forum for any questions you would have for us. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If your questions have been answered and you wish to withdraw yourself from the queue, you may enter star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, you may enter star and 1. We have the first question from the line of M.K. Reddy from MR Investments. Please go ahead.
Yeah, thanks for the opportunity. My question is regarding this ERP suite. Last year we have been less invested in sales and marketing regarding this ERP software suite. What are the management plans for particularly for the ERP segment to gain momentum in this strategy?
See, what we said is in the last quarter is we are focusing on the few segments in the ERP, in particular area of dominance what we have into in the area in which we are continuing. Our order procurement for the ERP will be into the very, very focused area. That is what we have said, and we are continuing with that one. So right now also our revenue-wise, 1/3 of our company's revenue it comes from ERP, and equivalent amount of allocation and the bandwidth is allocated for ERP business as well.
Yeah, continuing with the same here.
I'm sorry to interrupt the current participant. Please could you switch to your handset? Your audio is fluctuating.
Okay. Yeah, my current question is regarding the same ERP segment. This ERP is mostly digital transformation deals. Are we seeing any pressure in the implementation cycle?
On the implementation front, all our ERP implementations are on a track. They are going fine. I think that is your question. Are we facing anything from the implementation side or market-wise you are asking?
No, the implementation cycles take a longer time, so our revenue recognition may affect. That's what the question is.
No, I think it is speeding up. ERP, we are fine. All the implementations are on track, and in other part of the implementation for the HRP and all, we are actually, in fact, speeding our cycle for implementation with the technology investment what we have made.
Yeah, just an extension to your answer, sir. When we are doing the implementation, the partner will do the implementation projects. Ramco will only sell the license, right? Is my understanding correct?
No, we are having both the model. We are also implementing ourselves, and our partners are implementing. For the license, if it is there, and anyway we recognize it with the immediately.
Yeah. Contribution to us. When the partners are implementing further, they will do the implementation projects, and the license is Ramco sells the license. And that means we are entirely dependent upon the partner implementation time frame when he will close the deal. I mean, the sales cycles are typically longer. That's what I understand.
No, I think I'm not able to hear very clearly. I think sorry, I think your speaker or something I'm not able to hear clearly.
Okay, I will come back into it. Thank you.
Thank you. Participants, if you have a question, you may enter star and 1. We have the next question from the line of Madhur Rathi from CCIPL. Please go ahead.
Good afternoon, sir. I'm relatively new to the company. So
Mr. Rathi, I'm really sorry to interrupt, but please use your handset. Your audio is low.
Is my audible better now?
Yes, please go ahead.
Yeah. So I'm relatively new to the company. So if you could just help me understand why have we made losses for the last 2 years and the reason behind the same. So that would be very helpful.
Sorry, Madhur, we could not hear you properly. Can you please speak a bit louder?
Hello, am I audible, sir?
Now better.
Yeah. Sir, so I'm relatively new to the company. So I was going through your financials. So last 2 years we have faced losses. So if you could just help me explain why have we faced losses, so that would be very helpful.
No, it's a generic question. It has to be answered in details. But anyhow, see, the last 2 years we had a dip in the order booking, and which has affected our revenue. So the revenue base was lower, and with the expenses being of fixed nature, they remain at a constant level or were increasing because we have to take care of the employees in terms of to curtail the attrition, etc. So that is the main reason. There is a generic answer. We can go into specifics if you have to analyze the financial statements fully.
Sir, just like what kind of orders that we had for the past 2 years and what kind of orders are we planning in the future, so I can just have a sense of understanding of where our losses are coming from.
No. Yeah. I don't know whether you had a chance to look at our fact sheet. Fact sheet fairly gives you the details of what are the segments we are into that and what is our order booking. And if you see historically, our order booking has been, for last financial it is $90 million in US dollars. Normally the currency used in the company is US dollar million. And we have been booking 27 million, 23 million, and last quarter we have booked 23 million. That is order booking. This is a combination of ERP orders, HRP orders, and aviation software orders. And our order booking, the unexecuted order book or order backlog as of 30th June is 196 million.
So, in fact, we have given a lot of details in our fact sheet. You might be seeing for the last 8 quarters, whatever we have booked across all geo, all business line, it's all handily available. My request would be to go into that, fact sheet, which is in much detail we provide information.
Okay, thank you, sir. That will be very helpful. And sir, what is their outlook for the next 2 to 3 years in terms of top line and margins going forward?
We don't give the forward-looking guidelines. What we have said is, if you hear what our CEO informed and also based on the past, what we are seeing, we have a healthy backlog of the order book, and we have witnessed consistent order booking, and that gives us the confidence that future revenue should be in the better position. That is all we gave the indication, and we stand by that.
Okay, thank you, sir.
Thank you. Before we move to the next question, we would like to remind participants to use your handsets during the Q&A session. We have the next question from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Joining as a CEO.
Yeah,
am I audible now?
Yes, please go ahead.
Yeah, sure. Yeah, thanks for giving the opportunity, and congratulations to Mr. Sundar Subramaniam on joining the company as a CEO. I had the question largely on the sure. So, sir, largely I just wanted to understand this business, ERP part of the business. Given the fact when we see the global market, it's largely concentrated across the top 5 companies. 65 to 70% of the market is controlled by the top 5 companies. And whenever any corporate graduates to an upper level, they generally try to move to either of the ERP of the top 5 companies. So it's a very R&D capex heavy business. So, how do you change to what is the right to win that we have in this particular segment? And, given the fact it's a very R&D heavy capex heavy business, and in that context it becomes difficult. So just wanted to get an understanding how do you try to compete, and what are your thoughts on this? But just my second question was on the cash part of the piece. If we see over the last 7 years, the company has raised roughly 600 crores of cash, out of which 200 crores has been written off as bad debt. So just wanted to get an understanding. Is there any issue in the underlying quality of the business itself that we are doing, or is it more related to accounting? Just wanted to get an understanding around that. Those were the questions.
There are 2 questions. I will answer the first one. I think your question was on the ERP is a crowded market, and what is the area you are competing and what are the things. If you historically see the company, I think it is, while we started as a ERP company, whenever we have found an opportunity to specifically provide services in a niche vertical segment, we have created that as a business unit. For example, today, what you see as aviation, what you see as HRP, or what you see as logistics, they all come from the same fabric. And whenever we have seen the opportunity, we have identified the area which we can specifically provide niche services and dominate. That is how we have created the segment. And within the larger ERP, what we call as the remaining all sitting in the ERP domain, we are continuously looking for area where we can differentiate with our competition, like in facility management or into asset intensive industry, where we have a differentiated product, and we are looking for the market and product fitment, and then we are accelerating our growth there. So instead of generically competing in the generic ERP, we have chosen an area of finding specialization and then putting all our energy behind those vertical to grow the business. That is what we have adopted, and that is consistently which we will continue to pursue in the coming years also. And second,
Sundar here, let me add one more thing. So I'm fairly new here. See, the ERP, in terms of ERP, as Sandesh said, we focus on very specialized markets, and we have a specialized set of customers who really go after. We don't really do across the breadth. We don't really go after different customers. That is one. Second thing is that you talked about the investment. A lot of investments have been made in the last 15-20 years. So today, if you look at our platforms and the product, they are IP rich, and the IP rich is because of the years of sustained investments that have really gone into those products. So I think in many of the products that we are in, the investment cycle is kind of coming to an end. Right now, what we are looking at is primarily upgrading the technology so that it can ease the implementation for the customer. So that's what we are really looking at. The second part is that also, if you look at the last few years, we have also steadily shifted from the on-premise to cloud. And 60% of our orders that we have today, and this has seen a significant growth, gradual significant growth in the last 3 years or so, from moving from on-premise to cloud, it is totally around 60%. So we have a significant set of our customers as in the subscription-based model, and which is a very different business from that of a traditional ERP business. So to that extent, we have also diversified over a period of time. It is not just a standalone ERP servicing only the industry. We also cut across all the industry, go horizontally with our cloud offerings today. In fact, some of the deals that we won, which Sandesh spoke about, we won the global, the insurance company That is we are looking at around 20 odd countries. Single platform, subscription based, 20 of countries we are servicing those customers. So that is the diversity of what we have in terms of our offerings.
And on the cash flow side, I think, what you have seen, I think that is the part of the, some of them are, part of the business, and some which we had explained in the earlier quarter, that during the COVID, when we were executing and picked up the order, we could not have people on-site, and our implementation quality, what we could have, it had a little bit of, we did suffer. And some of the customers didn't want to move forward, and wherever we witnessed, risk in the business, we are writing off those areas, and that we explained in the earlier call. But that is what that does not reflect on the inherent product strength or anything. It is more to do with the particular instances which we are tackling. But you are able to see that our revenue this quarter has increased from traditionally around 15.5 in the last 4 quarters. It has jumped up to 17 million, and we are expecting to see further incremental growth there.
Sure, sir. Sure. Noted. Just a follow-up then on that, accounts receivable write-off. The overall cumulative number accounts to close to 5% of revenue. So, is this a normalized number in the industry, or is this an elevated number? And if this is an elevated number, then how do you intend to take steps in order to correct this?
Look, there are a couple of areas in the last couple of quarters. Our investments have gone into actually improving the significant jump in the delivery capabilities through automation. And I think that we spoke about the last quarter also, the area what we are investing to see that making more of a people independent delivery by our experience, adopting that into automation. That we have invested. You have to wait for probably late next quarter for us to come and give the further update. But we have taken action into automating our implementations also.
Sure, sir, sure. And just a last follow-up on this. Should we consider $2 to $3 billion quarterly run rate that you had highlighted to continue to be there for the rest part of the year?
Sorry?
The provisions, the run rate that you had highlighted last time, $2 to $3 billion on the provision side, should we consider that to continue for the balance part of the year?
Yes.
Sure, sir.
That is what we have given the guidance. Yeah.
Sure. That's it from my side, sir. I will join back in the queue. Thank you very much.
Thank you. Participants, if you have a question, you may enter star and 1. We have the next question from the line of Rohit from iThought PMS. Please go ahead.
Hello, sir. Am I audible?
Yes.
Yeah. Good evening, sir. Sir, my first question was, we have this unexecuted order book of about $196 million. Can you just help me understand how will this be, what is the duration of this order book? If you can just help me understand, that's my first question.
Yes. Look, we also, the 196 million, I think it is roughly 25 to 30% of them each year we will be consuming. For example, we were around 195 million at the beginning of this quarter, and we added 23 million to the that bucket, and we consumed 16 million out of that one. So that has moved. Then some exchange fluctuation was there. If you apply that, we moved slightly higher to 196 million at the end of the quarter. That is how we will be consuming out of this unexecuted order book. And whenever we are booking the new order, it will go into our unexecuted order book position. Typically, we can look at around 25 to 30% of that we might be consuming in any year moving forward.
Right. So roughly in 3 to 4 years, assuming, hypothetically, if we don't add any new orders, hypothetically, this would get over in 3 to 4 years. Is that understanding correct, sir?
Correct. Yeah.
So, sir, in terms of just again, sort of building on this question further. So this would mean that roughly it will be around $50 to $60 million kind of yearly revenue. Again, I'm just trying to build on top of it. I know you will get more orders to build and it will grow further. But this number, if you look at it over the last 2 quarters, has been stagnant around this 190, 195. And that's the genesis of this question, that we were doing about $18, $20 million revenue per quarter. So when do we sort of get back to that and then grow on top of that? If you can just explain that and help us understand.
Yeah, I think you would also, we also touched upon that. I think more from on-premise to, we have made also the adjustment from on-premise to cloud. There is one change which has happened in the over last 2 to 3 years, and that has actually resulted in our recurring revenue going up and steady existing business consuming. Even in the current quarter, if you see, around our total revenue of 17 million, 16 of that came from unexecuted order book. So similarly, I think in coming quarters, we are hoping to continue with our order booking or to accelerate that one, and we expect revenue to be seeing uptick trend. I can't put the exact number, but we are hopeful of looking up in the coming quarters.
Currently, the pipeline looks pretty healthy. We are firing on all cylinders to make it happen.
And sir, which segment is between the three, ERP, HRP, and AAP? Where is the biggest delta, or the pipeline is the strongest? Where are you seeing the biggest pipeline growth?
If I have to rank them, it is the HRP, aviation, then ERP.
Our cloud offering in the HRP market has got a lot of momentum behind it. So I think that's where we are seeing a lot of pipeline building up for us.
And is it driven largely by the connectors that we have built for companies like Workday and Oracle? Is that what is driving, sir? Or you can just maybe spend a minute there as well?
Yes, I think that is one big part of it. And also having the payroll rules and regulations for 65 countries on a single platform, our customers see that as a very big differentiator. And that is helping us.
Right. And sir, in terms of our attrition right now, can you just talk a bit about that? What is the current level of attrition? And our employee costs have been fairly well managed. So how do you see that moving for this year?
We are looking at around ending year at around 18 to 20%, which is down from 32 to 34% peak, which you saw in the last year. This is from the attrition percentage. We are saying it is a steady, and I think there is no pressure right now on the employment cost perspective-wise. We are not seeing any pressure there.
Okay, so this employee cost that you have, that also includes the ESOP cost, right? About 5 crores?
Yes.
So in that sense, actually the employee cost YOY has actually fallen, right?
That is correct. Employee costs will keep following. But however, one thing I would like to draw your attention, we are actually more of a product company, right? There is no linear direct relationship with the employee cost, but I think the increase in the revenue will be more. That is what our focus is, to optimize on the cost from the side of the employee, but actually increase our revenue. That is what is our quest.
Yeah, and second thing is also, we are investing also on the automation heavily, and as we automate, the headcount also comes down. The productivity goes down, the headcount comes down, and since we are not in services, we are a product and a platform company. That really helps us from the cost side of the equation.
Right. So one last question from my side before I join back in the queue. So in terms of I think this question I have also asked this question previously, and a lot of other participants have also asked. So we have this around 4-5 crores of write-off that we are doing, and you've said, I think in this call also, in the previous call also, that this will continue for a year or so. So just want to get your understanding what will ensure, what are we doing to ensure that this doesn't repeat in the future? Because these are not small write-offs over the last 2-3 years that we've seen. So if you can just maybe help us understand that part, it will really help us.
Yes, I just spoke earlier a little bit on the implementation side, and also automating the implementation cycle, governance, and also having the proper mechanism to see what kind of order and exactly how we are doing. All those we have put in place, and if you see, we have given the guidelines that it is up to the end of this 4 quarters guidance we had given, and we hope to curtail and move forward. We have put in place identified areas, we have taken actions.
Okay, thank you.
Thank you. Participants, if you have a question, you may enter star and 1. We have the next question from the line of Sharad Jutur from Zen Wealth Management. Please go ahead.
Thanks for taking my questions, and congratulations to the new CEO, Sundar Subramaniam. So basically, I have one data point related question, what would be the outstanding debt after repayment during the previous quarter? That is first question. And can you go ahead with the second question, or
You are talking about the borrowings?
Yeah, borrowings. Yeah, outstanding borrowings after the repayment, which was seen during the Q1.
8 crore, end of Q1 is 8 crores.
8 crores, right? Okay, thank you. And another question was relating to turning EBITDA positive. I think it's a bit too early to ask in Q1 itself, but I just wanted to check if there are any downside risks we are seeing to that in the year so far, or we are well on track to turn EBITDA positive. And in relation to that, can you also give commentary on the cost savings we were to see on the employee side? Like we were planning to save around $6 million on the employee cost. So can you just give clarity on that as well? That's it from my side. Thank you.
I think, Sharad, you have been very... I think the line is not very clear. Can you repeat it? Maybe slowly that would help us.
Yeah, is it audible now?
It's audible, but you may have to go slow because the line is not really clear.
Okay. My question was about turning EBITDA positive during the current fiscal. It's a bit too early to comment on that, but I just wanted to check if you are well on track to achieve that, or are you seeing any downside risks to that plan?
No. In our view, we are on track as per the plan. Maybe a bit early to comment whether we'll be having EBITDA positive. We have probably going to have another 3 quarters, and the trend continues, probably will be nearing towards that scenario.
See, we are winning newer deals, and we expect with a lot of automation tools, we think the margins will be higher in those deals. And some of because of the tools that we have deployed, we have also reduced the headcount. And the headcount kindly helps us positively with the margin situation for us, right? It decreases the cost for us. if with all these things put in place, I think the next 2 to 3 quarters we will see some positive momentum there at this point of time.
Okay. And actually, last quarter we also spoke about cost savings in employee cost. Like, can you just give some color on that? We were to save somewhere around $6 million on the employee cost. Like,
what is 6 million? Can you please repeat, Sharath? What is the 6 million you are referring to?
$6 million on employee costs. Employee costs during the fiscal, and we were to see some sharp rundown on the employee cost front. Like, I just want to check, like, post wage hikes and all, are we on track to achieve that, or is it more gradual process? Like,
see, we have cut down around 4.5 million so far, which is the last quarter that really happened through the last quarter. So we would not really see the results immediately in the last quarter. We would see that in this quarter. An additional thing which is also happening as we speak. You know, we are looking at both at people that we have here, people we have at on-site, people we have as part of the implementation team, our sales teams, the marketing team. We are looking at each and every role and looking at whether those roles make sense, and we are taking a call based on that.
okay, so it's more of a gradual thing. Yeah, thank you. Thank you very much. That's it from my side.
Thank you. Ladies and gentlemen, to ask a question, you may enter star and 1. We have the next question from the line of Rohit from iThought PMS. Please go ahead.
Sir, just following up on the previous participant's question, in terms of like your break-even, I mean, at what kind of sales level and given the cost cutting that you, I mean, whatever investment you're doing in automation and the savings that you have from your employees and overall other cost benefits that you're seeing, at what level would you break even, excluding the other income, other expense, I mean, the provisions that you have broadly?
Your question was excluding provisions and other things, is it?
Excluding provisions, sir, basically, yeah.
I think that is we are looking at around excluding provisions. If you are saying it's around 18.5 million.
18.5 million.
Per quarter.
Yeah. Understood. So we are almost, 10 crores away from that number, actually, right?
Correct. We are
very near that. Yeah.
Yeah. Okay. And so this provisions, you're saying this number should not go up from here on, or there is an accelerated provisioning that you will take over the next 2-3 years quarters to sort of finish the write-offs?
Look, that is the current view what we have taken, and that is what we have been telling. I think that is the corrective action required for that we have taken, and we hope that will revive all the area, and it should not add up to. That is what our current read of the situation is.
Right. No, I'm just trying to understand the worst case. I mean, the worst case is probably 3 quarters more of provisioning of about 15 crores of provisioning, right?
Crores or million?
I think
per quarter.
Crore, right? Yeah, per quarter. We've done $2 million this quarter, so about 16 crores. Last quarter was about 15 crores. So this 15 crores is each quarter is what we are assuming for the next 3 quarters as the worst case, or this is an optimistic case, is what I wanted to understand.
My view is not 16 crores, not the worst case. We are conservatively considering this amount. Probably we will be taking a review at end of each quarter, and depending on the development, we may take the call. Rohit.
Sure. Okay, sir. Okay. And sir, in terms of this year, you've been positive, and also you said the pipeline is looking good, and while the numbers may not have been visible from a headline perspective, given the change in mix from on-premise to cloud. So not this year maybe, but over the next couple of years, what do you see in terms of growth for you? I mean, what will make you, whatever hard work that you guys are putting in as a team, what would make you sort of happy that this is the kind of growth that we were envisaging and this will be achieved? Is it like 15-20% growth or more, or that's too optimistic?
Good question. See, I think he's asking a wish.
Look, our focus has been, as we said, bringing the EBITDA positive, both from the perspective of top line and managing the cost. And we are focused, and at the same time, as we have been consistently telling, we have become a very sharp focused on what we do. So we have our internal targets very clearly set out, but probably I will hold this stage to give any guidance. But we are looking for good to moderate growth internally to say, we are successfully achieving that. That's the internal targets we have. Just give us a couple of quarters before we come out and clearly put forth what we are looking for in coming years.
Sure, sir. No, fair enough. All the very best, sir.
Thank you. Ladies and gentlemen, to ask a question, please enter star and 1. We have the next question from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Hi, sir. Thanks for giving. Sir.
Mr. Manohar, sorry to interrupt. Your audio is fluctuating.
Yeah, am I audible now?
Yes.
Yeah, sure. So, just wanted to get a sense. Our cloud business has gone up over the last 2-3 years, but despite that, our unbilled revenue as a percentage of, that still remains at the similar levels of 45 to 55%. So, why is it so that despite our cloud business going up, still our unbilled revenues have not come down as a percentage of sales? So, just wanted to get an understanding around that. How does the accounting work? And my second question was on the deal wins side. When we see the deal wins, typically the book-to-bill ratio, has increased for us from the levels of 1 to 1.3, 1.4. Growth picking on this deal wins, or this deal wins, are these deal wins fructifying into revenue, or is there a halt on the implementation of the deals that we have won? So, just these are the two questions.
No, on the first question on unbilled revenue, I think it's actually coming down. Year on year, it's coming down, and if you see historically, we have been at a high of $50 million 3 years back, which we have now consciously brought down, and it is now at $23 million. It is in that range. And this will take some more time we have to liquidate, because we have whatever taken as the unbilled license, that portion will be there. It is period driven, and only over a period we can bill and reduce it.
And percentage of unbilled to our total revenue definitely has come back. I don't know which is the number, but you can look into it. Is it has come down, and both on the constant term as well as for the percentage of revenue, both it has come down. In fact, it is a good amount of write down. That is from the unbilled perspective. And as you said, our book-to-bill ratio is, that one is increasing.
Do we see this deal with...
Mr. Manohar, I'm sorry to interrupt once again. Your audio is fluctuating again. Sir, I would suggest if you could come back on a better line, sir.
Sure.
Or adjust your instrument.
Yeah, is it audible? I think I will join back in the queue. Yeah, thanks.
Thank you. To ask a question, please enter star and 1. We have the next question from the line of Vivek Kumar from Best Pals Research and Advisory. Please go ahead.
Thank you, sir. Are you able to hear me? Am I audible?
Yes.
Sir, my first question is on what segments would drive the growth, and why are you more confident now? Because we have been doing this 20-odd million order booking from last 5, 6, 7 years. We have not crossed that threshold. And Sundar sir had said that the investment phase in terms of product is over, R&D is over, and but there's a distribution and but also marketing also will entail a lot of investment. So will our margins improve? So 2 questions. One is, why are you now confident that our order booking will substantially go up, and which segments would drive in the next 2, 3, 4 years? And two, why do you think the investment, do you think to come back to better margins because now we have to spend on marketing and distribution? So you can throw light on how would our margins look and our P&L look through this journey of next 2-3 years? Thank you.
I think before Sundar answers, I think there is some number-wise I will give some help here. I think it is for the 7-8 years, what you said, 20 million consistently we are per quarter we are booking. That is not correct. Post-COVID, our booking significantly had dropped, in fact, to 11 million, 17 million, and it was oscillating all over, which right now is stabilized over 20 million per quarter for the past 4 quarters. I think that is the one data point which gives us the confidence that our consistent order booking, we can climb up from here and move forward. That would give us enough firepower in the bank so that we can continue on growth on the revenue journey. And I will hand it over to Sundar to provide his thoughts on segment and what we are planning and how it will eventually translate into.
Yeah. So thanks, Sandesh. That's very helpful. So if you look at it, for example, in aviation, and that's a very specialized vertical, and we are getting into different areas in the aviation. And one such area that we have gotten into recently is on the engine side, which is a deep investment, and that we are kind of nearly done, and we think that would be helpful. Keep it aside. If you look at our HRP, three things that are really helping us in a big way in terms of HRP. And one is the partnership that we have with other players like Oracle and Workday. And many of the deals have really come because of that, because of the teaming arrangement we have with them. That is number one. The second one is that in the countries that where we don't really serve, we have really teamed up with other partners where we can really go together so that we do provide the complementary services. And that is, in fact, one of the recent wins are really helped by that fact because of the partnership. The second one is that. The third is that, as I already told you, there are no vendors primarily in the HRP market where you have the payroll and regulations of 65 countries on a single platform. And that is also helping. With many countries post-COVID getting into the multinational rollout of the HRP platform, and that really makes us more and more confident to get into that area. And that is also, we are also, along with that, when you move into the HRP area, multi-country, we are also doing a lot of cloud-based SaaS business. So the SaaS segment of our business is expanding. And primarily with the help of the partners, our marketing and sales costs will also come down. So when I told that, and also in the next quarter, I think Sandesh mentioned it some time back, you will also see in the next 1 or 2 quarters, we have fairly in a very advanced stage of creating some new toolkits that can ease the implementation, that can really accelerate the implementation and also better the processing time of payroll. That we think that would really give us a leg up in the market space. So that gives us the confidence, Vivek.
So I was asking about the growth also, sir. In the sense, next 2-3 years, which are the segments you think will drive the growth and why you are confident that we would up our order booking from 20 million to the next level of quarter?
Yeah, predominantly I think for all the things I have said so far would really help us to only grow. And when I said the investment cycle is done, see, we are a product company. We are a technology company. So we will keep investing in our products. We will keep investing in our platforms. We will keep investing on our people. There are no alternatives to that. We will continue to do that. What we are taking a look at this point of time is that whether that investment is a right investment or a wrong one. So that is what we are looking at this point of time. Second is that with some cycles coming down in HRP, predominantly in HRP, and what we are seeing in this marketplace today, that has really given us a confidence. So if you are asking us to put a number to that confidence, at this point of time, we can't really do that. Maybe 2 quarters down the line, we will be more confident about putting a number to that confidence. Today, we are confident because of the conversation that we are having with our sales folks, our marketing folks, our teams that are supporting it, and also our customers and prospects and partners. So that is giving us the confidence today.
And this This is across aviation or HRP or even in ERP, or you're confident across all the products, all the segments?
I think predominantly I would say definitely HRP and aviation, because aviation we are hyper specialized in some areas, and HRP because we are broad based and we bring a lot of things together in a single platform, and ERP it's an ocean. So we are really looking at certain islands where we can really create our dominance. So that is what we are looking at, specific areas in ERP.
Thank you, sir.
Thank you.
Thank you. As we have no further questions from participants, we would like to hand the floor back to the management for closing comments. Please go ahead, sir.
Thanks everyone for joining this call. We would like to thank you all for patiently following us and having interest in what we are doing. Look forward to catching up with the next quarter. Thanks.
Thank you.
Thank you.
Thank you.
Thank you, members of the management. Ladies and gentlemen, on behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.